Okay, so I want to transition to a few slides, and on a weekly basis, I'll try to share several slides just from an educational perspective. And in the comments or feedback, I mean, let me know what you like, what you don't like. Feel free to start discussions, to ask questions, etc. Again, the goal here is to get people to like, subscribe, to share, try to get 100,000 people across the platforms interested in talking about preserving wealth and getting a little bit of silver and a little bit of gold um, based on the likely recession that's headed our way. So this is the MoneyFlower, and the MoneyFlower, as you can see down on the right, this was started by Bank for International Settlements as an educational item. I know some people have taken this and changed it up a little bit, but basically what it shows and what we'll talk about in the upcoming weeks is how there's derivative markets that are set on top of what is real money being historically in the millenniums, gold and silver. And how fiat cash works on top of that, how Bitcoin may work on top or correlate with that, Fed coin, where a lot of central bank digital coin initiatives are underway, all the way to things like mortgage-backed securities, where those are basically financial instruments of consolidated mortgages that were then sold on Wall Street as an investment vehicle that would have certain returns, rates of return on them. And obviously, back in 2006, 2011, that 5-year stumble on the real estate market, you saw lots of foreclosures. Think of it as a piece of pie. That there's several pieces inside of these mortgage-backed securities that were reflected with thousands or hundreds of mortgages. When several of these mortgages start to fail or foreclose, then those instruments would become questionable. They would have lower rates of return, lower ratings, and so that's kind of what started the housing debacle then. There's several derivative markets on the MoneyFlower that can start a crisis like that. We've seen a little bit earlier this year with the regional banks, for example, because of liquidity and call outs on bonds and stuff that they had, that unrealized gains that they had to start to consider. So again, the MoneyFlower is just a great visual to understand at the very base is silver and gold. And again, a wealth advisor should be telling their clients based on their risk profile what percentage of their assets or their investments they should have in silver and gold. And when you ask people, people do not have anywhere close to where they factor themselves in on those risk profiles. So that's something we'll be talking about in the future. Just like this slide, because it shows how erosive really fiat money has been, inflationary it is. We've printed in the last 3 years the same amount of money that we printed in the 200 prior years. So we've got a lot of money splashing around out there, which has put a lot of pressure on assets like homes and making the home prices increase, which can't be long lasted. So housing is the most unaffordable that it's ever been. So it just shows in today's term, this is a slide from 2023 here. It shows median house costs $410,000. Whereas, back in 1968, when this slide starts, it would have been like $18,000. Whereas on the left axis, you can see the amount of bars or ounces of gold in order to own the same house has actually stayed pretty steady. So anywhere rotating from that 213 number up to like 500, maybe double that. So right now, with gold at $2,000, it takes 213 ounces to buy that same median house, whereas it's cheaper now in terms of gold than it was back in 1968. So these are kinds of things that people don't necessarily consider, and why it's good to store up. If gold were to go to $4,000, then you would only need 100 of those ounces, to give you an example. So this is really important, and we'll get into it later, but banks, central banks and sovereign nations have been gobbling up gold here in the last several years because they changed the asset classification of gold about 3 years ago. Whereas it was a tier 2 asset, it's now a tier 1, which means it has the same balance sheet effect of cash, which means it's more desirable. So you can see central banks and sovereign nations gobbling it up, because if there is a asset pressure on other types of assets and gold does climb, that their balance sheets will be somewhat solidified with the percentage of gold holdings they have. So if you have, for example, a big bank that gets 10 to 20% of their holdings in gold, and it's considered as cash, as a tier one asset from a valuation standpoint, and gold climbs 500%, I mean, it could easily match the asset values that it has on other things. So this is why we're seeing, again, the sovereign nations and central banks buying up so much and able to mitigate that risk. And this is something the everyday American doesn't necessarily realize, and should. You should be doing the same thing with your household, in terms of having some in case that were to happen. The other thing that's kind of keeping the house of cards alive is, in terms of the market propped up when maybe it shouldn't be, is a leading indicator for a recession is unemployment. And unemployment hasn't really ratcheted up. We have an inverted yield curve. An inverted yield curve over the last 6 decades is a 100% indicator of an oncoming recession, for example. But before that can happen, we have to see unemployment go up. But as we can see, the government is, every month, they're coming out with favorable numbers on unemployment, but the very next month, after the headline news has done its job, they revise those numbers in the other way. So we're not really necessarily seeing the true unemployment rate. And the other thing that's masking it is we got lots of people holding 2 full-time jobs, which this graph illustrates. And so this is another way that the unemployment rate's being masked. But at some point, we'll see leading indicators where this rises, which means more and more people will have a harder time, making the payments on their mortgages. And then that's when you'll start to see the foreclosure rates increase. And so these things happen over several years. People tend to forget that the housing bubble last time when it went down was over a 5-year time frame, and we're really only into 21 months so far of when the Fed started raising the federal fund rates this time around. And so we have a longer lag time right now, and most likely this will be a topic that we talk about. It's being masked or punted because of the amount of fiscal spend we're doing on wars. That tends to fall into the military spend and kind of keep things propped up. So we've got a lot of things that are kind of keeping GDP growing, but we've got some other clear signs that, again, like an inverted yield curve, which is 100% correlation with oncoming recession. So we'll continue to watch those things as part of this podcast. This is a pretty busy slide, but I love it. It's one of my favorite things to follow on Twitter is North Star Bad Charts. This is just a very mathematical way to illustrate that the trend on gold and silver is most definitely up over the next decade. These guys do this kind of technical analysis on all kinds of stores of value, money, stock, bonds, etc. And these same kind of patterns exist everywhere, and they're very reliable. And so I'll be educating on this. I know it might be busy or too heady for some, not wanting to wrap their minds around it. But all I can point to right here is at the base of this bowl, like 2019. You can see clearly that we're starting to see upward trend in metals, and it becomes more and more parabolic, meaning that the slope steepens, and prices will start to go up more. So that's what these guys are tracking. They give probabilities to it, where we're headed. So we're definitely in a bullish trend for the next decade. It's why people should be considering gold and silver. And you can see in terms of a bullish trend, we have a lot of these bear traps where people, you see the price go down, they'll think, oh no, it's going down. This is just very typical over long periods of time, years. These kinds of things play out in terms of years, not days and weeks. They happen very slowly, then all of a sudden at once you see big moves. Like here, you see enormous moves in a very short time frame, and then you see a consolidation pattern. Then we're kind of coming up against this curve again, and we should see again a very drastic upswing in the price. And so These are important trends just to be aware of, and gives you some confidence when you're saying, hey, I should be, my wealth advisor should be telling me I've got X percentage of gold or silver. So I should just, get to what the standard is for managing risk, and then I don't have to worry about it. So this is just a good thing to look at people, to give them confidence that we're in this trend where rates and et cetera are going to be higher for longer, which is going to keep um, things consolidating along these lines, pushing towards higher price in metals. The other thing that's become important is people are from a risk management standpoint, looking for insured, kind of on that money flower, gold and silver, things that you can hold. More important than just, risky assets that have typically gone up like stocks over the last 20 years. People are pulling money out of 401ks to put them into just funds with the bank, and FDIC insured funds too. I'm not talking about money market funds that aren't FDIC insured. Right now at Chase or Wells Fargo, you can go in with your banker and put money into a fund that's paying over 5% and it's liquid. In the example of Chase, it's 1 day liquid. Wells Fargo has some products that are like 30 days liquid. You can get them out, but they're FDIC insured, which means there's no risk of losing your basis investment, and there's over 5% upside on an annualized basis, which is just fantastic. So that's why we're seeing a lot of people pull out of these as well. Inflation, I mean, everybody knows that the headline news is telling us there's not inflation, but it's just not the fact. And so this will be something I just continually hound on, is inflation. And I'll start to share links that track how inflation used to be tracked by the government, but how that's now masked and conflated with other things. So we all are experiencing inflation at the gas pump, at the grocery store, wherever. Obviously, inflation is here and it's not going away. Housing is more expensive than it's ever been. I kind of already had a graph on this, but here's a monthly mortgage cost. We've seen it gone up parabolic. What goes up must come down. The Fed seems pretty committed to keeping rates higher for longer until something does pop. And so one of the things that does need to pop is going to be the housing bubble. And we have the lowest supply of homes ever. And what keeps the price up is we have even lower demand. And that's because people don't want to leave their current low interest rate and walk into a brick wall with an 8% mortgage. So basically the whole market's frozen. So it's not going to be until unemployment rate raises where people, it's not just divorce and death, but it's going to be people losing their jobs. It forces them out of homes, and home prices in neighborhoods are priced on the margin. Your home's value is based on what was the last home in your neighborhood, what did it sell for. So entire neighborhoods and entire groups of assets are valued on prices on the margin, which just means the last one sold. So when all of this changes, when at some point when this demand, because of unemployment, outstrips the low supply that's out there, we're going to see pretty quick and fast changes in the pricing of homes. So we'll continue to watch for that. In fact, where we live, we just saw our first short sell. I have been investing in real estate for over 30 years. I think I mentioned here that I started my career with Freddie Mac and the Federal Home Loan Mortgage Company, doing loss mitigation on foreclosed homes. And so it's something I've invested in and tracked for 30 plus years. But here where I live, we just saw our first short sell on a 6,700 square foot home go from 1.3 million down to 1 million in price, which means they want to hurry and work with the bank to get that thing sold. So whatever they've put into it for the last 2 years, you can tell when they bought the home, they bought it 2 years ago, they've been paying into it for 2 years. They're willing to give all that upside up over the last 2 years because they still have some upside, and to get their money out of it before they have to go to foreclosure. So that's something to look for, is start looking for short sells in your market and foreclosures. But before that, you'll probably start seeing a lot of price reductions in your specific market. This is just a slide that shows a lot of earnings. A lot of companies have a lot of unrealized losses they still need to work through. So earnings per share, we're going to see some downward pressure in lots of industries on earnings per share, because there are, especially companies that hold real estate holdings, commercial real estate, et cetera, where there's lots of losses that need to be realized on their paper. We've seen it already happen in medical MPW, which is a ticker symbol that tracks medical properties out there, has just taken a beating over the last year and a half. And that's just typical with the timeline. It usually starts with medical properties, then works into commercial, and then works into residential. It's just very typical patterns that happen over years, and people that know the market just kind of watch for that. And we've already seen it occur on medical, but it's starting to happen in commercial because people don't have these 30-year mortgages on commercial paper, and they need to turn the paper and recapitalize or do a reloan, and now the rates are higher. And so at some point it just becomes where it's just not worth it, and then that property will go into foreclosure. So we're going to see lots of unrealized losses happen in lots of markets. This basically just is a slide where I wanted to make the point that gold is one of the most heavily manipulated commodities. The paper trade on this is 100 times the market value on a daily basis. That happens between some bullion banks and JP Morgan. JP Morgan has incurred fines over the years for this kind of behavior, but the amount that they make is 20, 30x times the fine. So they just continue to do it, and it has not stopped. And so it remains a very depressed or suppressed commodity relative to all other commodities. So when that breaks eventually, and again, central banks are positioning for this. Anybody can go research sovereign nations buying gold. Go put in Google, search central banks buying gold, and you'll verify what I'm saying. They're all positioning for this kind of these things to come back into correlation. And then the last thing for today's podcast is that's the pressure that's going to force something to break is just going to be the amount of debt that we have and debt to service. The amount of our GDP that goes to servicing debt is just growing phenomenally. In fact, I think as of today, I think it's we're the end of October. I think we're on almost $1 trillion run rate a month for the debt increasing. It's just something we're going to talk about, but this is going to be one of the items that just kind of forces a reveal of something to break. Don't know what that's going to be, but this is what we're watching. And again, now's the time to prepare for wealth preservation. Make sure you get a junk of silver. Basically, that means older coins that are 90% silver, and or tubes of 1 ounce silver coins. I think you can, for $500, buy 20, for example. Just start to stack, start to set aside some. I think it'll give people a lot of comfort, and I think we're going to start to see those prices rise here as through the charts that I've seen to you or have showed here. So I just want to get that education out there. So like, subscribe, and share this, and try to help me get to the 100,000 subscribers across the platform. Hopefully we can help impact a lot of people for good. Thank you.